When it comes to a whole life insurance policy, setting it up the right way is one of the most important things to do. Now, what I mean when I say setting it up the right way is making sure that that policy is set up to handle payments or handle funding in the way that you want to fund the policy. For example, someone recently reached out to our office and he stated, I want to be able to fund the policy between $50,000 and $100,000 per year. However, I only want to commit to $10,000 to $15,000 per year and then be able to add the rest to my PUA rider throughout each year. Our PUA rider is our paid up additions rider. It's often very flexible. It's how I maximize the cash value. But what does he want to do here? So we've got to make sure we set it up right. He wants to be able to fund somewhere between $50,000 and $100,000 per year. But he doesn't want to be billed for that. What he's comfortable with as far as a yearly commitment is somewhere between $10,000 and $15,000. Then when we see this, add the rest to my PUA rider throughout the year, that's a very important line he added, and it provides so much information to us because now when I see that, we know that we've got to provide a couple of different companies. Maybe there's one company that's really going to accommodate him well based on the desire to commit to a small amount and add up to this desired amount at his discretion, depending on his cash flow. When he feels he can fund the policy at this dollar amount, he wants the control. He does not want to be billed for $50,000 or $100,000 per year. He also stated that he'd like to fund the policy for 15 years. He's starting at age 35. That'll take him up until age 50. He did have questions before this. He was curious about a policy where he could pay into it forever. Then he narrowed things down and wanted to see what it looks like if he funds a policy for 10 years or 15 years, but then expressed that he's leaning toward funding it for 15 years. So he's done some research, or I should say we've had some back and forth. But setting it up right based on these goals are so important. So we've got the word flexibility, and then 2 life insurance companies that we are presently considering, and he'll pick the one that he prefers the most. But I want to hit on the flexibility piece first, because this is really important. And this has to do with setting the policy up the right way. So if after looking at different scenarios, he says, I'm comfortable committing to $10,000 to $15,000, let's say it's $10,000, but the most I ever want to pay into the policy, Steve, is $50,000 per year. Not 100, but 50K. What we would do then is set up a policy maximized for cash value. Premium would be at about $5,000. So that would be his minimum commitment there, minimum premium, not 10 to 15, but 5. If he still wanted to pay in 10, let's call it 10 per year, he said, I still want to commit to 10, but this was the design that we recommended, or we recommend. What it would look like, S stands for scheduled. We'd have a scheduled PUA for another 5. So now he's billed for $10,000 every year. We're setting the policy up so he's billed for the premium and the scheduled PUA. That scheduled PUA can be adjusted each year. So even though he's billed for it, does not mean that he's locked into it. But then have the ability to add more PUAs to the policy. We have U, that stands for unscheduled, of $40,000. So this way, we've got the policy at 10% of the total desired payment, which is about as low as we can drive it in this example, very close to the minimum. But he still wants to be billed for 10. So we just add some scheduled PUA payments. And then if he wants to add up to 50, he has the ability to do that. Now, if he wanted to go up to 100K, we would double everything. That premium would be 10. We would not have a scheduled PUA. Maybe it's 5 if he wants the total amount 15K like we see over here. But we would double everything where we've got a 10K base premium, pay just that, and then add more PUAs into the policy at discretion. Maybe you have a small scheduled PUA. But that's the first thing we would do there, just to set it up so he's able to commit to the amount that he wants to. And then with respect to company selection, so when he's looking at different options, he had referred to products with MassMutual, their 10-pay and 15-pay policy. So that 10-pay and 15-pay product with MassMutual is an attractive product. And right now we're leaning toward the 15-year funding, so that would be the 15-pay policy. However, he mentioned this. I want to commit to $10,000 to $15,000 per year. Why is that important? Well, with Mass, they do have some flexibility, but what I cannot do is have a policy where I commit to 10 only, and then at discretion, I just throw more money into PUAs. Meaning if I wanted to do it every month, I could just log onto a portal, throw it into the policy, extremely flexible. We're assuming we want to go up to a total of $100,000 per year. Couldn't do that. These two need to be paid at the same time, generally. MassMutual does have one PUA rider that has some flexibility, but it's also got some limitations to it. We've got that in our All About MassMutual video. It's their planned AILR rider. When we set up a policy for maximum cash value and flexibility, the big takeaway is these two need to be paid at the same time. So if he started a policy, let's say he starts off with a lump sum of $100K, that's in year one, and then in year two, he says, I don't want to pay $100K, and we scale it down to $15K because that's what he's comfortable committing to. If he wants to add more money during policy year two, say 6 months into the policy year, can he do that with MassMutual if he wants to add more to PUAs? The answer is maybe, or technically you can, but MassMutual might come back and require medical underwriting first before they accept the money. It can be a bit of a pain for some people. Where MassMutual works very well is if he waits until his policy anniversary date next year. At that point in time, we can adjust the PUA dollar amount to any amount we'd like up to the maximum. Let's say he goes up to $50K. That way he pays the $10,000 or $15,000 plus another $35,000 in PUAs for a total of $50,000. The big takeaway is we can easily adjust payments one time per year, provided we set it up correctly. That's with MassMutual. So if he likes the idea of committing to $10,000 to $15K, my question specifically would be, are you comfortable adding more money one time per year on your premium due date, your policy anniversary date? Or would you prefer to pay just the minimum on your anniversary date and then add more money at discretion? If he says, hey, I really like Mass, they're a large company, I'm comfortable taking any extra money I would normally add to the policy, I'll just save it, I'll put it in savings over here, and then when my due date comes, I'll take the money from savings and move it to the policy. I'll let you know how much I'd like to add that year. You could do that. Some people do that. If he said, I'm not really feeling that, what he could do over here, set it up where he's committed to 10 or 15. If he wanted to commit to 15, we would add a small PUA on top of the 10. But then everything here can be added at leisure. So let's take a look at these. So what we'll look at first, just the illustrations very quickly. This is the MassMutual option, $100K per year for 15 years. This is one page of the illustration. 15 years up until age 50. Strong cash value, about a $2 million death benefit right out of the gates as well. So that's funding at $100K per year for 15 years. Here's the exact same policy. Take note of the first year cash value and first year death benefit. First year cash value and death benefit are identical in this option, or this illustration, but what's the difference? Look at year two. It's showing $15,000 per year thereafter. So we're starting with a lump sum, and then we're illustrating what it looks like if he only pays the minimum. And then we've got Guardian. So here's a sample with 100 per year going in, but I want to point something out here, which is what a lot of people do that we work with that gravitate toward Guardian. Net after tax outlay, here's how much we're illustrating going into the policy each year. 100 per year for 15 years, total of 1.5. Up here, Here's your premium. Let's highlight this in yellow. This paid up additions rider is a scheduled PUA. $1,900 and change. Add those two together, what do you get? $11,000. And this, by the way, this scheduled PUA covers this, the $1,600 charge for OYT. OYT represents 1 year term. That's the cost of your term rider. That's what that is. So, minimum commitment with this guy is $11,000 per year. Then we're illustrating what? Paid up additions rider. Same thing, but what term do you have here? Unscheduled. Now he can add it at his discretion. It's on an unscheduled basis. If he wants to, he can. He's not committed to it. What we're going to look at is this policy and what it looks like if he only pays $11K, if he pays $50K, and then the option we have up now, if he pays $100K per year. This way, you've got 1, 2, 3, side by side, same exact policy. You could start off day one with this, and then we're seeing what it looks like if you add more money to it. If you wanted to see additional scenarios, we could. If someone said, hey, what's it look like if I do 30 or 70, or if it fluctuates over time, just to give me an idea of what my policy will look like if I add more or less money over time. So let's take a look. What we'll look at first is the Mass Mutual option very quickly here, which is the same thing, meaning starting with a minimal amount, then 50, and then 100. This is all the exact same policy. So 15K minimum, we started with the 100K right out of the gates, and then 15,000 per year thereafter. With this option, we only paid in 50, and this is the same policy. Why the death benefit is less initially is because if we add less money into PUAs, PUAs push up the death benefit. That's why we're lower initially, but we did set it at just a high enough number there to still have a 100K MEC limit, so we can go up to 100K per year. The main takeaway with this, though, is he would have to be comfortable adding to this 15K per year commitment on the policy due date. If he's disciplined and comfortable with that, this will work perfectly fine. There's no issue with it, and a lot of times people are comfortable with that, but it depends on the individual situation. Let's look at the Guardian sample. So what we have first, this is that illustration we just looked at with Guardian, but just the minimum going in. So annual minimum, this is that base premium, that was about $9,000 and change. Then you had that PUA that covered the cost of the term. It was $1,900 and change. Total, $11,000. Additional PUAs. We're not adding anything extra. That's why our annual outlay is $11,000 per year. Ignore what's highlighted in yellow here. Not attractive at all. The break even, look at this thing. 22, 23 years. So whenever you're looking at a policy where you have the ability to add a lot of money, but you're starting with just the minimum, what's good to be aware of is when we look at the numbers, they won't be attractive. This is set up so we are only billed for this. So this would be an illustration in a formal contract for someone that plans on committing to the minimum only and then adding more PUAs at their discretion, which a lot of people do. Let's continue on here and look at the same policy, but what it looks like if he adds 50 per year. So same annual minimum, and now we're assuming another 39,000 per year in PUAs is added for a total of 50. Break-even point is just about year 6. That's not optimal. And the reason why is because we have a policy with a minimum of 11, the base is $9,000, a large death benefit to accommodate funding at 100K per year for 15 years, and we're not ever hitting 100K. We bit off more than we could chew if we end up funding just this. If someone's unsure, what I would look at specifically is a policy where they're still paying in 50K per year, but I cut the minimum and the death benefit in half. This way we've got a policy that is optimized for 50. Now let's look at the last guy. Here we go. This is that illustration we had up. If you rewind the video a bit, you will see these values match up. They are identical because it's the same illustration, just exported to Excel. Levy minimum, additional PUAs, total out-of-pocket 100K, break-even point, year 4, healthy death benefit just over $5 million, and there you go. So now he can see, what does the policy look like if I get in what I want to get in? What's it look like if I get in half the amount? And then I can see what it looks like if I only pay the minimum. However, I know that I only want to commit to 10 to 15K, so I can commit to this and add up to this as the years pass. Now I've got that flexibility. The policy was set up how I want it to be set up, meaning the right way, so it's flexible, and I have the opportunity to maximize the cash value. So I hope you enjoyed this video. This is one of my favorite things to talk about and put together because it's really, really neat just what you can do with a life insurance policy from a design and flexibility standpoint. I do hope this helps. Please let us know if you have any questions. Feel free to leave them below, and we'll talk to you soon. Thank you again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.